Hello and welcome to Accounting 101A. Today we'll be discussing accounting, introduction to accounting, some of its concepts, and some of its history as well. So first let's introduce you to accounting. Accounting has evolved, as in the case of medicine and law, in response to the social and economic needs of society. As business and society become more complex, accounting develops new concepts and techniques to meet the ever-increasing needs for financial information. Without such information, many complex economic developments and social programs may never have been undertaken. Accounting is relevant in all walks of life, and it is absolutely essential in the world of business. Accounting is the system that measures business activities, processes that information into reports and communicates the results into decision makers. So, what is the definition of accounting? Accounting is a service activity. Its function is to provide quantitative information, primarily financial in nature, about economic entities that is intended to be useful in making economic decisions. As stated here, accounting is a service activity. Service meaning we sell our time. Its function is to provide quantitative information, primarily financial in nature. When when entities need information, especially quantitative ones, we provide them in order to help them in making economic decisions. Accounting is an information system that measures, processes, and communicates financial information about an economic entity. Please take note again the financial information. Accounting deals with financial information, primarily financial in nature. Accounting is the process of identifying, measuring, and communicating economic information to permit informed judgments and decisions by users of the information. So, accounting helps businesses or entities make decisions and judgments. Accounting is the art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions and events which are, in part at least, of a financial character and interpreting the results thereof. So let's skip the history of accounting and move to the part of the we're not gonna skip all of the history, but let's move here to Luca Pacioli in page 7. Luca Pacioli, a Franciscan friar and a celebrated mathematician, is generally associated with the introduction of double entry bookkeeping. In 1494, he published his book Summa de Arithmetica, Geometria, Proportioni, and Proportionalita. Don't quote me on that. Or everything about arithmetic, geometry, proportions, and proportionality, which includes particularities de computis et scripturis. Don't quote me on that again. Or details of calculation and reflected the practices of Venice at the time, which became known as the method of Venice or the Italian method. Therefore, he did not invent double-entry bookkeeping, but rather described what were prevalent accounting practices of the day. Although Pacioli made no claim to developing the art of bookkeeping, he has been regarded as the father of double-entry accounting. Please, please take note, Luca Pacioli is regarded as the father of double-entry accounting. He stated that the purpose of bookkeeping was to give the trader without delay information as to his assets and liabilities. So, yeah, the important information here is that Luca Pacioli, which is considered the father of double entry accounting. So let's move on from all of the history and let's go straight to here, the fundamental business model. As you can see, This is the business model. Uh, it shows flow, the flow of business or the cycle of business, where first a business owner invests cash, which in return is kept in banks or maybe used in products or services, which in turn makes sales, and, and from those sales we have what we call receivable. Receivable are, as the name suggests, receivable from customers, meaning they did not pay yet, but we will receive the payment in the near future. So from those from those receivables, we collect cash. We collect cash, and from that cash again, it is either it is either put in prod put as cost for products or services or kept in banks. And the cycle continues, which is the which is the definition of the fundamental business model. We move on to the types of business. So although the fundamental business model does not vary, there are infinite ways of applying it to provide a range of products and services that make up the business world. However, the range of products and services can be summarized in seven broad categories. They are as follows. First, we have services, or a service type of business. Uh, it involves selling people's time. Examples include, of course, we have accounting, we have legal, we have software development as well. Next, we have trade, trade or the buying and selling of products. Manufacturing and trade close, close business model, but the only difference is that manufacturing creates their products while trade buys them. Trade includes groceries, sari-sari stores, and others, while manufacturing includes the makers of furniture. Uh, we have vehicle assembly, construction, and others. Next, we have raw materials. Raw materials involves the growing or extracting raw materials. Examples includes the farming, mining industry, and oil. Infrastructure includes buying and operating large assets and selling the utilization of it. Example includes hotels. Hotels buys buildings and they sell the utilization of those buildings in the form of rent. Transport, like the airport, trains, and others. Telecoms, sport facilities, uh, and others. Next, we have a financial type of business. This includes receiving deposits, lending, and investing money. Of course, the most notable example are banks. Banks receive monies from many and they make money themselves by lending those money that they get to other people. They, the the income they earn from interest uh, are are their sole income. Next, we have insurance. Includes pooling premiums of many to meet claims of a few. So, uh, examples of insurance include life insurance, fire insurance, and others. So, we move on to the forms of business organization. We have three types of business organizations. We have sole proprietorship, partnership, and corporation. Sole proprietorship has a single owner called the proprietor. Sole proprietorship is the easiest one to form because you don't need a lot, a lot of requirements to build a sole proprietorship. You just need yourself and the business. For example, an online business is considered a sole proprietorship as long as you're the only one, the only sole owner. Next, we have partnership. Partnership is the business owned and operated by two or more people. Please take note that partnership is two or more. And any number of people can form a partnership as long as it's two or more. Either 20, 25, as long as they agree among themselves, it's still considered a partnership. Um, from the accounting viewpoint, sole proprietorship and partnership is distinct from the proprietor and the partners, meaning the accounting records of the business does not include the personal personal records of the owners or owner. Next, we have the corporation. Corporation is a business owned by its stockholders. It's an artificial being created by operation of law, having the rights of succession and the powers, attributes, and properties expressly authorized by law or incident to its existence. A corporation is a lot harder to create than a partnership and a sole proprietorship because it needs the operation of law. You one cannot easily create a corporation. It needs a lot of process. It is also considered a legal entity, meaning that a, a corporation's liabilities does not extend to the stockholders. Um, a stockholder uh, a stockholder are those that invest in the corporation, those that buys the stocks of a corporation. Uh, So in turn, those stockholders receive money from the corporation depending on the amount of shares that they have. So a stockholder is not connected to the corporation, meaning that if a corporation has lost all of its money and the liabilities of the corporation remain unpaid, the creditors cannot go upon the stockholders because the corporation is a separate legal entity. Um, Micro, small, and medium enterprises are those that the law defines under a specific amount of assets or net assets. I don't know if these are updated, but I think it's changed under the train law. So we have activities in business organizations. We have we have three types of activities: financing activities, investing activities, and operating activities. First, let's go with the operating activities. Let's start with the operating one. Operating activities involve the use of resources to design, produce, distribute, and market goods and services. Operating activities include research and development, design and engineering, purchasing, human resources, production, distribution, marketing and selling, and servicing. Organizations compete in supplier and labor markets for resources used in these activities. Also, they compete in product markets to sell the goods and services created by operating activities. So essentially, operating activities are those activities done by the business in order to create income. Selling their supplies, their inventory, those are types of operating activities. Paying interest from their liabilities, those are operating activities. As long as it affects income, it it is considered operating activities. Next, we have financing activities. Organizations require financial resources to obtain other resources used to produce goods and services. Financing, financing activities are those activities that a business does, a business do in order to get sources of money. For example, an owner in deposits in his business. That's a financing activity because the business gets finance or money aside from its income. If a business gets money from income, those are parts of operating activities. Stockhold If a corporation sells its stocks and stockholders buys them, those sales from the stocks are considered financing activities. Next, we have investing activities. Managers use capital from financing activities to acquire other resources used in the transformation process, that is, to transform resources from one form to a different form, which is more valuable to meet the needs of the people. Having the right mix of resources is essential to efficient and effective operations. An efficient business is one that provides goods and services at a low cost relative to their selling price. An effective business is one that is successful in providing goods and services demanded by the customers. So basically, investing activities, as the name suggests, are those activities that business do in order to invest. For example, buying a buying a building. Buying a building is an investing activity because you're investing in that building for a long period of time. Another example is buying another company's shares of stocks. Um, please take please take note that when you buy stocks, it's an investing activity because when you buy stock, you give money to that corporation in order to invest in that corporation. And from that investment, you receive money yearly or monthly, while under financing activities, you sell stocks in order to receive money. And from those selling
You
of
give
stocks,
money
to the investors or stockholders in the form of dividends. So, selling stocks is a financing activity, while buying stocks is an investing activity. Please don't be confused by that example. Purpose and phases of accounting. The accounting function is part of the broader business system and does not operate in isolation. It handles the financial operations of the business but also provides information and advice to other departments. Business transactions are the economic activities of a business. Recording these historical events is a significant function of accounting. So, Um, in the normal course of business, we have transactions. We either sell or we buy things. We pay stuff. We pay expenses. We pay liabilities. So from those transactions, it must be recorded. And in order for those transactions to be recorded, it must be measured. And in order for that accounting information to be useful, expressed in terms of a common financial denominator, which is money. Money serves as both a medium of exchange and a measure of value. So, after we recorded it, we measured it, then we recorded it. Of course, we need to we need to sort this. Recording transactions isn't enough. In order to be more useful, we need to classify it and summarize it. Classified and summarized. Classification reduces the effects of numerous transactions into useful groups of or categories. So I forgot to mention when recording, we record transactions in the journal books or the journal. While 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 we classify it, we move these transactions into groups or categories under the ledger. So recording involves the journal, while classifying involves the ledger. Next, after we classify it, we need to summarize it. Su- Summarizing is done through the financial statements. So we will we will be discussing in the future different types of financial statements. So after summarizing all of this, and after summarizing this into the financial statements, of course, in order for it to be useful to outside parties or to the users, it must be interpreted or analyzed. We need to interpret and analyze it in order to evaluate the liquidity, profitability, and solvency of the business. All of these provides the decision makers with information to make reasoned choices among alternative uses of scarce resources in the conduct of business and economic activities. So we will stop here for our first discussion. We will continue next meeting. Thank you for listening.